Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this weekly stock market update for the week ending Friday, February 1st, 2019. Before I jump into the charts and commentary, I would like to begin with the quote of the week, and it's from one of my favorite books, In a Pit with a Lion on a Snowy Day by Mark Batterson. Mark Batterson said, "The greatest opportunities are still the scariest lions. Impossible odds set the stage for amazing miracles. What if the life you really want and the future God wants for you is hiding right now in your biggest problem, your worst failure, your greatest fear? Live your life in a way that is worth telling stories about. Chase the lion. It is what you are destined to do." Those are some wise words from Mark Batterson. Well, this week we had a Federal Reserve meeting on Tuesday and Wednesday, and the Fed has officially completely capitulated on their monetary tightening campaign. Back on October 3rd, the Federal Reserve had plans for 4 more interest rate hikes, and Jerome Powell said on October 3rd that the economy was overheating, and just so happens that October 4th was the day that the stock market broke and began a 20% decline. And over the next 3 months, the Fed went from, we're going to raise interest rates and the economy is overheating. And by the time we got to today, the Fed is now saying that the economy is weakening. No more interest rate hikes are likely. And as a result, it's more of the same. The Fed is basically supporting the stock market with easy money. So, because of the Fed's capitulation, the stock market has now retraced about 61% of its 20% drop from October. And it looks like the bear has left the building, at least for the moment. And we need to be willing to accept that the Fed is willing to inflate the stock market all the way back to all-time highs. And we need to take it one day at a time, because I am not sure that's possible, but we certainly need to pay attention in case it is. I haven't done a thorough chart review in a while, so I am going to do that today, give you some perspective on some industry sectors as well as the major indexes. But I really just wanted you to know that what has caused the stock market to skyrocket over the past 10 years has now been reintroduced in the last few weeks. And the Fed is looking more and more likely to be willing to inflate the economy and the stock market, and we'll just have to see if they can pull it off. Let's go ahead and jump into the charts, beginning with the Dow Jones Industrial Average. In this chart of the Dow Jones Industrial Average, you can see that we have had quite the euphoric rally from the day after Christmas until today, right here, represented by that red line. And we have retraced about 60% of the way back to the highs of October 3rd, but we may not be out of the woods yet, and this is where the next few days is going to be very interesting, because if you connect the highs of October, November, December, and the current price, you will see that we have still not broken out to above the downtrend. I'm going to switch this chart from a line chart to this candlestick chart, and I want to draw a line from the all-time high of October 3rd to the all-time high of December 3rd and project that forward, and you can see that it pretty much lines up perfectly with the high of yesterday and today almost. So we came up yesterday on the 30th after Jerome Powell's press conference, hit that declining trend line and backed off. Today we rallied up, hit it again and backed off. So we're still underneath that declining trend line, even if you consider it as a line chart. So I'll go ahead and switch it over to a line chart and just show you that it still holds true if you connect the highs on this chart just like that. We have not broken above the new above the downtrend yet at all. So we need to give it a few more days here and see how the Dow Jones Industrial Average plays out. But right now we're still stuck in that downtrend. We just got a little bit too bearish and went right down the well and bounced up and hit that line one more time. So we'll see where we go over the next 7 days. Here is a 6-month chart of the S&P 500 stock index, and you can also see the big rally since Christmas, but I'm going to go ahead and switch this over to a candlestick chart so we can see the highest prices of each day and the lowest prices. And I'm going to connect a line from the all-time high here on October 3rd and connect that to the all-time high of December 3rd and project that forward. And you can see that as of January 30th, following Jerome Powell's Fed press conference, the S&P 500 closed above that line for the day. And on the 31st, which is Thursday, the S&P 500 continued higher. So right now, the S&P 500 does have a breakout of its declining trend from October to the end of January. So a little more bullishness here, generating a breakout for the S&P, unlike the Dow Jones Industrial Average. If you haven't seen this chart yet, this is a chart of the S&P 500 since January 1st, 2008, showing the last stock market decline and bottoming out process here on March 2nd, 2009. If you draw a line from that low up to the lows of September, October, December of 2011, and you extend that out and you incorporate these lows of January and February of 2016 and project that forward, you can see that the S&P 500 hit that line perfectly on Christmas of 2018. I added some red circles there just to show you each time that the S&P 500 and tagged that long-term 9-year trend line, and it is still holding. So as long as that holds, we're still in an uptrend, but the S&P 500 tagged it on Christmas and then just took off like a rocket and bounced up quite substantially, and we need to wait and see where this goes, because 100% of the time that the stock market sold off like it did from October until Christmas, this was about a 19% decline from October 3rd until Christmas and Christmas Eve. 100% of the time in history that a 15% rapid sell-off has occurred, we have retested the lows that were made, which means that there's a good chance that this bounce after Christmas will result in a retest and will come all the way back down again, which will be, if that does come true, again, it's happened 100% of the time in the past, doesn't mean it has to happen again. But if we do retest those lows of Christmas, that would be a 13% drop for the S&P 500, and it would mean that we would have broken this 9-year red trend line. So that's just something to keep an eye on, is a retest of the Christmas lows and support at that red 9-year trend line. Here is a 6-month chart of the Nasdaq 100 stock index, and if I draw a line from the highs over the last few months by changing this first to a candlestick chart, I'll draw a line from the high of probably October 1st here to the high of December 3rd and project that out. You can see that the Nasdaq came down and bottomed out on Christmas Eve, took off, broke that on January 17th and January 18th, came back down and tested it again from above, tested that red line again from above on January 29th, and then the last couple days took off like a little rocket here on January 30th and 31st. So the Nasdaq is the strongest index of the bunch. It has a very strong breakout, and now we need to wait and see where this thing goes. Here is a chart of the S&P 500 Consumer Staples Stock Index from January 1st of 2018, and you can see that we fell from November, right here, November 9th, down to the lows of Christmas, and then we took off and had that real nice bounce right here from Christmas up until January 31st. So what we did was we came down and hit the lows of May 2018 right down here and bounced right off of that. And so far we've bounced 50% of the way back. However, if you look where the consumer staples stock index is today, well, we've got a slight issue in that, draw a line across here, you can see that consumer staples have gone absolutely nowhere since March of 2016. So in just about 6 weeks, it'll be 3 years, and the consumer staples stock index is the same price that it was 3 years ago. That is not a very good sign, and you can see the tremendous amount of volatility there. So that index isn't looking very strong in my opinion. Here's a chart of the S&P 500 Industrials stock index, and you can see that it has broken out of its October 3rd to December 4th trend line. So we did get a breakout to the upside, so that's a good sign for this index, showing some strength there. However, these particular lows back here in May 2nd and June across there, that is some pretty tough resistance for this index. It'll be interesting to see if the industrials can get above that. But as of right now, we are still below the December 3rd high. By how much? Let's just take a quick look and see here. That is about 3%. So if the industrials can't get above this December 3rd high and starts to turn down for some reason, then we'll have another lower low. So we'll have a high and then a lower low and a lower low, if that in fact occurs, if this thing can't get any higher. And that would be not a good sign at all for industrials, and that would mean that we're probably headed back down to the Christmas lows. Right now, though, everything's looking good for the moment, except for the long-term indicators are still showing a caution signal for industrials. Here is a chart of the S&P Home Builders Stock Index from January 1st, 2018 till today. And if I draw a trend line from the high of January 2018 down to the high of September 2018 and do just like that, you can see that the home builders are still in a downtrend. They have not broken above that line. And so we just need to continue to use caution regarding this home builder stock index for the moment. In addition to using caution, I also want to point out that home builders as of January 31st are at the same price as they were back here on February 17th, 2015. So they've almost gone 4 years without going anywhere in price. Same price as it was almost 4 years ago. So not a lot of strength there for the home builders. Here's a chart of the Dow Jones Financials Stock Index from January 1st, 2018. And if I draw in the trend lines, you can see what appears to be a breakout. If I draw it on this line chart from September 20th, 2018 to this high of December 3rd and project that out, it looks like the black line, which is the price of the index, has broken out. But actually, if you change this to a candlestick chart, which shows us the highs of every day, not just the line chart, which is the closing price, switch that over to a candlestick chart, and if I draw a line in, you can see that the high of this index, September 21st, connected to the the next high of December 3rd, and we draw that out just like that, incorporating these two highs, you can see that we came up and tagged that line on January 30th after Jerome Powell's press conference, and then on the 31st we came up and tagged it again and closed basically right on that line. So the financials have not broken out of their declining trend, and they really have to be getting tired after this gigantic rally since Christmas. This is quite the move, and stock market indexes typically don't rally this powerfully without a pullback. This has got to be getting a little exhausted. So we'll see where we go in February, but I would be a little cautious on the financials until we get that pullback. Thank you again for watching this market update. Before you go, I want to remind you that getting back to even is not an investment strategy. And I also want to remind you that it's a lot easier to make money if you don't lose it in the first place. We have an interesting situation over the last 4 months. As the stock market sold off, the stock market valuation actually got more expensive, meaning you're getting less for your money as the stock market sold off because the S&P 500 companies have lowered their earnings per share more than the stock market has declined. When I say lowered their earnings per share, their forward earnings per share for 2019. So the S&P 500 valuation, or value for what you're paying for, is getting more expensive because the companies are making less money. And the stock market hasn't fallen enough to compensate for that. So at the present time, stocks are currently more overvalued than they were when the stock market was at record highs in September and October. So keep that in mind. And also remember that for the 4th time in 20 years, we have a long-term caution signal on the Dow, S&P, and Nasdaq. The first one was in 2000. And we know after that the stock market, as measured by the Dow and S&P, dropped 50%. The second caution signal on the long-term indicator went off in 2007 or early 08, and the stock market fell 54%. The third one was 2016, after we had 2 back-to-back 10% declines, but that caution signal was reversed with intervention by the global central banks and by the election of Donald Trump. Well, that has worn off, and we have a 4th sell signal in the last 20 years, that is. And it's worth taking note because typically those long-term sell signals carry with them a tremendous amount of repercussions, I guess you could say. So take good care of your retirement savings. If I can be of service, let me know. I would like to help. And I wish you a very enjoyable weekend and week ahead. See you again in about another 7 days. Bye-bye.